This is the ASX, the Australian Stock Exchange actual stock, listed on the ASX market, obviously. And we were having a look at this the other day, and I mentioned it in one of my previous videos as well. And what we saw was that the market's been in this nice steady upward trend, and there's been a few times where it's obviously hit support and bounced off, and even these are very, very close, and a couple of opportunities here as well. But in particular, what I was most interested in is this particular day here, where we saw that ASX had obviously come back down to the support level, bounced and turned around, looking like heading up. So that was of particular interest to me, and possibly to you as well, because obviously what we've seen is a nice steady upward trend. It's bounced, it's come back down, it's bounced. So this particular bounce here, plenty of volume to support it. We were looking at potentially taking an entry into this stock. Now, supposing we did so on that day, then this was the 5th of June, and we saw that the stock had opened at $76, went as high as $76.50, as low as $75.64, closed at $76.31. Now let's suppose we got in on the open of this particular day because we saw the bounce, or perhaps we got in sometime throughout the course of the day. Let's imagine we got in to this stock somewhere in the midpoint. What did it go? High and open, high and low was 76.50 was the high, the low was 75.60. Let's suppose we got into this stock at about $76. Now, our actual exit strategy may be that we wait for it to break through this fairly long-term support line. Long-term in the sense that it's been tracking along this line since about December of last year or so. And as we can see that today, it actually did start to head south, and potentially it could come back down to the line and bounce off and keep going. And it could keep going in that direction for the next 6 months, 12 months, we don't know. But let's just suppose for a moment that we had a profit target, rather than saying, okay, we're happy to stay in this trade for as long as we possibly can, with the potential of it coming back to the support line, bouncing off and heading back up. Let's just suppose we made a profit target and said, okay, we want to make $10. So we bought at 76. And so our view is we're going to sell this stock if and when it gets to $86. Okay, and as we see from the chart, clearly that was possible a few days ago on the 5th of July. So, our opportunity to exit with a $10 profit would have happened here on the 5th of July, which was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, about 23 days later. But for the topic of this video, the question is, how much money do we need to start trading with? And this is a very common question. And I guess, there's a lot of, misinformation or perhaps wrong information. There's potentially lots of people who market stock market trading strategies or systems, saying that you can, make a lot of money and start with very little money and take very little risk. And, you've seen it all. No doubt you've seen it all. You've heard it all. And I'm not going to go into that here. But let's have a look at the reality of it all. Here's the reality. We start with a stock that we've paid $76 for. 23 days later, we sell it for $86 for a $10 profit. Now that's a return on investment, or a profit, of about 13% or so, I think. If we do a quick calculation, we started with $76. We've made a $10 profit, so we say $10 divided by the original 76 that we started with, times 100 equals 10 divided by 76 is 0.1315 something. And then obviously times that by 100 equals times 100 equals 13.15%. So it's about 13%, but we'll round it down to 13 here. So let's have a look at what that would look like. So let's just imagine you started with $1,000, okay? Times 13% equals $130 profit, which is great. If you had $10,000 and you made a 13% gain, that equals $1,300 profit, which is nice. And obviously $100,000 times 13% is $13,000, which is also nice. So let's just have a look at the maths here for a moment. To get a trade like this to make 13% is extraordinary, very good. And as you can see from charts and previous examples, very possible. However, the return on your investment is 13%. If you only start with $1,000, it's only $130 profit. Now, we're going to have a look at a moment how much it would cost you to do the trade with brokerage, and you're going to find that $130 is probably just going to cover your brokerage in and out and a bit of slipperage and that sort of thing, and before long, your whole profit's almost gone. $1,300 on the other hand obviously starts to make the trade very worthwhile, and $13,000 obviously even more so. The point I'm trying to make here is the risk is pretty much the same in that we've taken the exact same trade over the exact same course of time. So at any given course of time, we've only ever taken this same trade where we got in here and 23 days later got out here to make a 13% gain. Now, the point I'm making is with smaller amounts of money, it's actually, well, it's obviously not more risky because you're not risking as much money, obviously, but it's risky because you do need a huge move just to break even before you start paying your brokerage and all those sorts of things. You do need a fairly large move to make it worth your while. Whereas on the other hand, if we were trading with $100,000, we probably wouldn't need to stay in the trade anywhere near as long because we'd make a substantial gain in a much shorter time. And of course, by the time we pay our brokerage fees and everything, the trade could be worthwhile in a day or two rather than having to stay in the trade for a longer period. For example, if we did get in here at our $76 mark, a day or two later, we could have got out here for a high of $79. Let's have a quick look at that. So, let's suppose we bought the stock for $76 and 2 days in the trade, we decide to sell for $79 rather than waiting for 23 days for it to go up to $86. We've made a profit, obviously, of $3. But if we were trading with $100,000 divided by $76 equals about 1,300 shares or so. So, of course, if you've bought 1,300 shares with $100,000, you've made a $3 per share profit, then, of course, you're making 3 3s and 9 and 3. So you're making a $3,900 gain in just 2 days, which, of course, is, only 3.9%, nearly 4%. But it's still a lot more than what you would earn with your $100,000 sitting in the bank for 12 months, yet alone what you made in 2 days with the trade. Having said that, if you'd only started with $1,000 and took your position out of the market within 2 days, wouldn't be worth your while, because to buy $1,000 worth of shares would look something like this. $1,000 divided by $76 shares equals 13 shares. 13 shares times a $3 gain equals $39. Okay, and you can't afford to get out of the trade with a $39 profit. Profit's profit, but it wouldn't cover your brokerage, which we'll have a look at now. So all I'm saying is $1,000 needs to stay in the market a lot longer to make it viable for you to stay in a trade, because of your brokerage costs and everything. You need to make the money before you can obviously exit the trade. $10,000, obviously you'd make 10 times that, so you'd make $390 versus $3,900. So you can see that having larger amounts of money, yes, it's more risk because you've got more skin in the game, or certainly more money in the market. But at the same time, you don't have to stay in the trade as long, because you can make a substantial and worthwhile profit in a much shorter space of time, because you don't need a large movement to make it viable and worth your time. Let's have a look at our brokerage costs just to try and sum this up a little bit. Okay, here in Australia, obviously there are many brokerage options. Obviously what I'm looking at in this example is the ASX market, which is the Australian Stock Exchange. And so obviously trading an Australian share like ASX, I'm going to do so through an Australian broker like CommSec or Westpac or one of the many other stock trading platforms. If you're trading US stocks, there are thousands of other trading brokerage places where you can go and you can get fees as low as $2 or $3 per trade, which is a topic for another video. This one here, we're looking at the Australian market. So the brokerage fees here, as you can see, there's a heap of different scenarios here, but the bottom line is pretty much if you've got an account with CommSec and you're trading online versus ringing up and doing your share trades over the telephone, these are the prices we're looking at. Your brokerage fee for a trade up to and including $1,000 is $10. That's $10 to buy and then $10 to sell. For in the example where we're doing a $10,000 trade, obviously it's over $1,000 and up to $10,000 inclusive, which would be $20, and it would be $30 or $29.95 for over 10 grand and up to $25,000 inclusive, or 0.12% over $25,000. So for 100 grand, it's going to cost us 0.12%. or $120. So let's just do the quick calculation on that. Our first trade, where we wanted to trade just $1,000 of our trading account, was going to cost us $10 to do the trade in and $10 to do the trade out, for a total of $20. For our $10,000 account, we were going to be charged $20 in, $20 out, for a total of $40. And of course, if we were trading with a $100,000 account, we're not trading with a $100,000 account, we actually took a $100,000 trade, it was going to cost 0.12%, which is $120. So it's 120 in and 120 out equals $240 for the round trip. However, if you remember here on our 13% return, here we only made $130. Here we made $1,300. And here we made $13,000. Okay, so as you can see, $130 less $20 leaves us with $110. But we had to obviously take the trade for 23 days or so, so about $100 return. Not a great profit considering we had our money tied up for a month, 20 trading days, which is obviously a month. So we had our money tied up for a month and made $100 profit after brokerage costs, which on $1,000, I mean, it's still very good. It's still 10% after costs, still much better than you would get in any bank. But when you consider with putting a little bit more money in the kitty, we walk away with $1,300 less $40, which of course is $1,260, which then makes our rate of return 12.6% as opposed to 10. This is net. And then, of course, $13,000 profit before costs of $240 leaves us with a profit of $12,760, which, of course, then looks like a return for us of 12.76%, or close to the actual 13% that we made. So the bigger the amount of money we're trading with, the closer to the actual real 13% we get. Here was about 10%. Here was, 13 minus 40 is 1260, was about 12.6%. And, the bigger amount of money takes us to 12.76, which is much, much closer to the 13% of the real return we got. So, quick video there. It's not so much a question of how much do you need to start trading, because you could start trading with $100. You could open an account and take your first trade. In fact, my first account that I started some 20 years or so ago, I funded it and started with $1,000. And because I really had no idea about how these numbers all would play out and how they'd work, and got lucky in a few of the early trades. But the bottom line is, you really just need to sort of sit back and take a look at the probabilities, the risks, how much money you've actually got to trade with, and the return that you're expecting to get within some realistic parameters, obviously. It's all well and good to say, well, I'd like to fund an account, start with $1,000, and by the end of the year have $50,000 to trade with. The reality is you won't, unless you're an amazing super trader. So it also really comes down to what you want out of your trades. And what I mean by that, of course, is, are you a short-term aggressive trader where you'd like to get into the market today and out again tomorrow or the day after for a quick profit? And if that's the case, you're going to need a much larger account to make it sustainable and worth your while, because to make these quick, short trades, you're going to need a fairly large trading pool of funds to make it worth your while. Some people, many people, trade intraday, whereas they're day traders and they get in and out of a bunch of trades throughout the course of a day. And if you've got a large account, you can do so very successfully, potentially making very, very small trades. But because you've got a lot of money to move around the market, you can do so quickly and make some substantial returns. Maybe if you have a much longer term view of the market, rather than getting in and out quickly, you may look at a trade like this where you say, okay, you may have got in way back in 2015 when the stocks were trading at, around $36 to $37. Now, that's very viable to do with $1,000 or $10,000 or whatever you want to trade with. Because if you're buying shares for $36 that are now trading for $85, that's going to be a sensational rate of return. I mean, obviously, a stock down here at $36, even if you only had $1,000 to begin with, divided by a $36 trade equals, you're buying close to about 30 shares or thereabouts. I think it's 27. You're buying 27 shares down here at $36. 27 times 36 equals $972, so close enough. And then later down the track, you have those 27 shares are now worth, $85. That's about $2,300 or so. Okay, so starting with $1,000, you're now sitting on a bank account of $2,200, which of course is a profit of $1,295. With a profit of $1,295, considering we only started with $1,000, that's 130% return on your money, or 129% since 2015. So over 4 years, you've certainly more than doubled your money. So I guess the real answer is not so much how much money do you need to start trading, but more along the lines of how much money can you realistically expect to take out of the market and in what time frame. And when you look at the reality of it, obviously with a smaller account, you can't expect to make quick profits in and out of the market, day trading or doing, trades that only last 2 or 3 days, because there's just not going to be enough movement to justify your brokerage costs. Whereas rather than saying how much do I need to start with, reframe the question by saying, if I am starting with a smaller account, how long will I need to stay in my trades for in order to make it viable and profitable? Maybe a better question to ask. And as you can see here, not suggesting you needed to be in this trade for 5 years or 4 years or anything like that. But if you're trading with a smaller account, you need to look for trades that are potentially going to be longer and with the view of taking a much larger profit, but doing so in a nice steady upward trend. Having said that, of course, if you took the same approach with your $100,000 account, you'd be sitting now on close to $300,000. So it's all relative. It's just a different way of looking at things. Obviously, a stock like ASX as well, during the course of the trade from 15 to 19, which of course is 4 years, you would have also had the added benefit of collecting dividends along the way as well. So, quick video there, just to show you, I guess, the impact of how a different size trading account is going to affect your overall profits and what some kind of basic returns you could potentially expect depending on the size of your trading account, and how sometimes having a larger account, while yes, you are taking a bigger risk because you've got more money on the table, can also reduce your risk because you can duck in and out of trades a lot quicker to make it viable and worth your while. Hope that makes sense. As always, if you like this video, then please like it and also subscribe to my channel, because I've got lots more like this coming up. And as always, if you've got any questions, feel free to leave them in the comments section below, and I'll do all I can to answer them quickly. Thanks again, and enjoy your day.